This video is sponsored by Novium, creators of the hover pen. The United States has been the best place in the world to invest over the last 100 years. The US share of the world stock market cap has climbed consistently and now stands at over 60% of the world equity market, which is astonishing for a country that accounts for just over a quarter of global GDP. One of the reasons has been the success of US mega-cap tech stocks. Just three companies, Apple, Microsoft, and Nvidia, make up 10% of the global equity market capitalization. But even if you exclude the tech sector, America's share of global equities is still more than 50%, which is the highest it's been in decades. The reason investors all over the world love investing in the United States is that the US has deep capital markets, a fair legal system, stable rules and taxes, open capital markets, a business-oriented economy, and its markets have had great returns over time. Just yesterday, a British fintech company, Wise, announced its plans to switch its primary listing to New York from London in an attempt to attract more investors and improve liquidity in its shares. The stock rose more than 10% on Thursday after this announcement before falling back. There are reasons to believe that Wise's move might be unwise. While there has been a belief in recent years that US-listed companies trade at a premium to internationally listed companies, research by James Arnold at UBS has shown this to be untrue. He found that when comparing 60 British blue-chip stocks with US peers that were most similar to them, that the British stocks were either in line with US peers in terms of valuation or slightly overpriced in 40% of the cases. The underperformance of the British stock market was explained by the massive returns of US tech stocks like Meta and Amazon, which have no real peers in the UK or anywhere else. The reason that Wise's decision to relist in New York might not make sense is that the Trump administration has been making moves to punitively tax foreign investors in US securities, and to even apply these additional taxes to things like the profits earned by the US subsidiaries of foreign-owned multinational firms. The reason given is once again retaliation for the unfair practices of foreign countries. Foreign investors, who as a group have more than $60 trillion invested in the United States, are growing increasingly worried about a little publicized provision in Donald Trump's 1,000-page-long One Big Beautiful Bill Act, which passed through the U.S. House of Representatives last week and is now being considered by the Senate, which includes the most sweeping changes to the tax treatment of foreign capital in the U.S. in decades, under a provision known as Section 899. Foreign investors are already subject to a 30% withholding tax on things like compensation for services, interest, dividends, rents, royalties, annuities, and certain other payments. Purchasers of U.S. real estate have to withhold 10% of the sales price from payments to foreign sellers. The precise tax rate varies based on jurisdiction due to different tax treaties, but if enacted, the U.S. president would be able to apply an increase in taxes on dividends and interest on U.S. stocks and bonds by 5% per year for 4 years, which would raise the withholding tax to as much as 50%. Emmanuel Cao at Barclays suggested in a note that the mere passage of the tax legislation could make dollar assets less valuable for foreign investors. Trump's One Big Beautiful Bill Act also includes a 3.5% tax on remittances, which means that foreigners will possibly be punished for investing money in the United States using Section 899 and also for sending money back home, a form of capital controls. The head of FX research at Deutsche Bank told CNBC, Section 899 challenges the open nature of U.S. capital markets by explicitly using taxation on foreign holdings of U.S. assets as leverage to further U.S. economic goals. He said, "We see this legislation as creating the scope for the U.S. administration to transform a trade war into a capital war if it so wishes." There are A long list of ways that this could backfire on the Trump administration. But before I dig into that, let me tell you about this week's video sponsor, Novium, who create innovative high-end products that inspire curiosity and develop creativity. They make amazing Father's Day gifts. I love having a nice pen on my desk, and I don't want to have to search around in a drawer for one. The Novium Hover Pen, inspired by space, is an original and timeless gift idea, which even won a design award from Time magazine. I've been using two different versions. The Hover Pen Interstellar, a refillable ballpoint pen that hovers at a 23.5-degree angle on its base, a nod to the Earth's axial tilt. It does this using magnets and is available in a range of colors, and there's even one available with a meteorite shard embedded in it. Then there's the Hover Pen Future, which is my favorite as it has exchangeable tips, so you can set it up as either a rollerball pen or a fountain pen, which I prefer. It's available in deep black, frost silver, or mist blue, and you can even get one with a solid gold nib. Because the pens magnetically hover, you can spin them while they're floating on their base. Whether this is something for your desk or a gift for someone special, use code PATRICK to get 15% off for the first 48 hours and a 10% offer after. Novium offer free shipping to most countries, so be sure to order yours today. While Section 899 might at first appear to only impact foreign investors, it could cause all sorts of problems for the US government, US businesses, and US investors. Alan Cole of the Tax Foundation was quoted in The Economist describing this as being like the US telling the world, we're tossing a grenade at your stuff while it's inside our house, but we're also tossing a grenade inside our own house. He said that the White House must hope that the mere threat of Section 899 taxes persuades countries to wind back their own levies. At a time when the US is planning to add $2.4 trillion in additional borrowing to the US national debt, it might not make sense to threaten the investors that the US administration are hoping will buy the debt that they're planning on issuing, as obviously the riskier an investment becomes, the higher the return investors require to make it. At the current interest rates and the current level of debt, about 12% of the federal budget was spent on interest payments alone last year. That was more than was spent on national defense or Medicare. As the country borrows more, this will rise, and it'll rise even more if the US starts passing laws that allow the president to target investors on a whim. Bill Dudley, the former president of the New York Fed, wrote in an opinion piece for Bloomberg that America is becoming less attractive to global investors at a time when its government needs them more than ever. He cited the uncertainty of Trump's trade wars and the US government's dire and deteriorating fiscal position as reasons for tepid demand and rising interest rates. Section 899 applies not just to taxable foreign investors, but also to foreign governments, including sovereign wealth funds, state-run pension funds, and possibly central bank reserves, which under US tax laws are exempt from federal income tax on US source income from investments. The wording of the bill that passed the House of Representatives leaves it unclear whether it would apply to foreign holdings of US treasuries or not. If this tax reduces demand for treasuries and the US still wants to sell them, they'll have to pay a higher interest rate, which would just negate the tax. And while the higher interest rate offsetting the tax might seem like a wash, the very fact that the US government is willing to constantly change rules to, for some reason, punish foreigners for investing in the United States can be expected to make foreign investors wary of investing. As disruptive as Trump's tariffs have been, this new tax, if crudely applied, could be even worse, as the United States depends much more on international investment than it does on international trade. Foreigners have invested $62 trillion in American assets, while Americans have only invested $36 trillion abroad. The balance at 90% of GDP is by far the lowest net international investment position of any big rich economy. 1/3 of America's government debt, amounting to $9 trillion, is held by foreigners. The impact of Section 899 on businesses would likely be greater than its impact on investors. While the US claims to want foreign firms to set up factories in the USA, they are, on the other hand, threatening a high tax that would reduce the return on any investment they made. President Trump has been very busy over the last 6 months announcing all of the investment that he's attracted into the United States, and claims on the White House website to have attracted more than $10 trillion in commitments for foreign direct investment. The libertarian think tank, the Cato Institute, disputes that claim, reporting that a number of the companies on the list included in their announcements previously planned spending or developments that were already underway. They say that other announced deals have classic wiggle room, such as ambiguous timeframes, or are conditioned on the economic environment. The FT reports that these huge investment announcements have not translated into any upgrades to capital expenditure expectations at a company level. They report that almost 70% of Goldman Sachs equity analysts who cover companies with recent investment promises say that the pledges mostly overlap with their prior plans. They say that whether these announced investments are genuinely new or not, many of the projects are likely to be scuppered because of business uncertainty, pointing out that BCA Research's indicator of business investment intentions across the US is already in recessionary territory. The Tax Foundation estimates that over 80% of current US inbound foreign investment comes from nations covered by the legislation, like Australia, Britain, Canada, and the EU. The large Asian economies might, for once, get to watch from the sidelines. Japan is the only Asian country with an undertaxed foreign profits rule, which is not yet in effect, and China has none of the offending policies. I can't imagine that if Section 899 is passed into law, that any foreign firms will be moving money into the United States to have their returns taxed at a 50% rate. The wording of the bill leaves it unclear if it would apply to Treasury bonds. If it did, the yield on Treasuries would fall by around 1%, making them unattractive to foreign investors. Considering how much the US is planning to borrow in the next few years, it seems likely that the Treasuries would need to be exempted from Section 899, but that's not yet certain. The Economist argues that even if they are exempt, foreign buyers might reasonably wonder if the rules could change in the future, and that scaring them when there is such a big deficit to finance is reckless, especially when foreign investors have already become skittish about American assets after Trump's Liberation Day tariff announcement. Bloomberg reports that Section 899 would likely hit US companies who have borrowed from international lenders, as many lending agreements require borrowers to cover surprise tax hikes if they're enacted after the deal is signed. These requirements are known as withholding tax gross-up obligations, and they require borrowers, so US firms, to remit the withholding tax to the US government, but then they must gross up their payment to ensure that the lender still receives the full amount of interest owed. So, for example, a 5% withholding tax would require a borrower owing $1,000 in interest to a foreign lender to remit $50 to the US government and then gross up its payment so that the lender still receives $1,000 after tax. The borrower's combined tax and interest payment would actually be even higher, according to Bloomberg, as the gross-up payment itself is also subject to withholding tax. This means that they would find themselves paying 5.3% in additional interest if this 5% tax hike was applied. You might think that this is not a big deal. After all, how many American firms borrow from foreign-owned banks? According to the Institute of International Bankers, Foreign banks underwrite more than 70% of the debt issuance for foreign companies in the US, representing almost a third of total dollar-denominated debt issuance. Banks like Deutsche Bank, TD Bank, Barclays, and Santander are big lenders to American companies and would have withholding tax gross-up clauses written into most of their loans. A senior executive at a big Wall Street bank told the Financial Times that Section 899 is one of the more worrisome ideas to have come out of DC this year, saying, if this goes forward, it will definitely cool foreign investment in the United States. Morgan Stanley say that Section 899 would put pressure on the dollar and disincentivize foreign investment, while JP Morgan say that if passed, it would have significant implications for both US and foreign corporations. The Global Business Alliance, a trade group that represents the largest foreign multinationals investing in the US, says that the long-term implications will be quite severe for international companies operating in the United States. So what are the unfair foreign taxes that Trump is so upset about? Well, the bill targets countries who apply digital service taxes, which in the UK is a 2% tax on search engines, social media services, and online marketplaces on the revenues they made from their UK users. This is applied to firms from any country, but it mainly affects American tech giants. According to Chatham House, that tax brings in about $1 billion a year on average. The bill also targets countries with undertaxed profit rules, which are part of a 2021 OECD global tax deal, which the US played a pivotal role in pushing forward and involved 139 countries, including the US. Its purpose was to create a more unified international tax regime and require large companies to pay more taxes in countries where they have customers and less in countries where they are formally based. The agreement set out a global minimum tax of 15%. The idea was to tax companies who set up corporate headquarters in a low or zero tax jurisdiction while selling services to customers in countries that charge corporate taxes. Trump withdrew from this deal on his first day in office, describing it as a discriminatory foreign tax practice. In truth, the US has its own tax, which is a 10% minimum tax that's to prevent foreign and domestic corporations operating in the United States from avoiding domestic taxes by shifting profits out of the country. Section 899 is not the only thing that foreign investors have to worry about. On his first day in office, President Trump passed an executive order directing the Treasury Secretary, in consultation with the Commerce Secretary and the U.S. Trade Representative, to investigate whether any foreign country subjects U.S. citizens or corporations to discriminatory or extraterritorial taxes pursuant to Section 891 and to provide a report by April 1st, 2025. April 1st, of course, being Liberation Eve, which I expect to someday become a national holiday. If such practices are found, the President can invoke Internal Revenue Code Section 891 to double the tax rates on citizens and corporations of those foreign countries. Section 891 is a provision that was enacted under FDR in 1934, giving the President the power where if he determines that a foreign territory has a discriminatory tax and he makes a proclamation, then there is a doubling of tax rates on the citizens and companies from that country. Under Section 891, the increased tax rates could apply to compensation for services provided by globally mobile employees in the United States. So, for example, services provided by a U.S. non-resident employee sent to the United States on a business trip, or trailing compensation related to a previous period working in the United States, such as U.S. source retirement distributions or an employee stock plan, if not otherwise exempt. Increased withholding tax rates on investment income of those foreign individuals could also result in increased tax equalization cost to the employer. Section 891 was enacted more than 90 years ago to pressure France into signing a tax treaty with the United States, but has never been applied, so there's no established process for its use, meaning that it's difficult to predict how it might be implemented. No matter which side of the political aisles you fall on, you should probably always worry about giving a president new powers like this, as in the future a president that you don't like might be in office and use laws like this in a way that you think is harmful to the country. You might wonder why Trump needs Section 899 if he already has Section 891, which seems to have a very similar effect. According to PricewaterhouseCoopers, Section 891 is much more of a sledgehammer than Section 899 would be. They explained that if Trump applied Section 891 as a negotiation tactic and that the offending tax was then repealed by the foreign country, firstly, it just doubles withholding taxes on citizens and companies from the offending nation from 30% to 60%, but additionally, the president would have to make a second proclamation under Section 891 saying that the tax has now gone away, but that would not remove the additional taxes until the following year. Section 899 at least has a 180-day transition period before the tax applies, and then it ratchets up the punitive tax rate over a 4-year period, topping out at 20%. Section 899 also gives a rough definition of extraterritorial taxes and discriminatory taxes, where an extraterritorial tax appears to be the undertaxed foreign profits rule, and discriminatory taxes appear to be digital service taxes. The good thing about Section 899 is that it allows Trump to back down quickly if his actions backfire, while if Section 891 causes capital flight, a full year has to go by before it's repealed. There's been a lot of discussion over the last month about Robert Armstrong's taco theory, which is that US markets have held up remarkably well during all of the trade chaos because investors have realized that despite all of the tough talk, the US administration does not have a very high tolerance for market and economic pressure and quickly backs down when new policies cause pain. TACO stands for Trump always chickens out. Amusingly, a journalist asked Trump about this theory a few weeks ago, and he didn't seem too happy about it.
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
Don't ever say what you said. That's a nasty question. Go ahead. To me, that's the nastiest question.
One of the worries now is that Trump eventually decides to stand his ground on an issue like this to prove his critics wrong and causes sustained economic damage. Another problem is that while the TACO argument might make sense for short-term traders in financial markets, executives who make big investment decisions at large companies are not making short-term decisions, especially when deciding on capex like building a new factory. Faced with trade and tax chaos, these executives might have no choice but to assume that Trump is not chickening out. If they worry that a large tariff or investment tax might be applied on a whim, it probably makes sense for them to hold off on that investment and wait for clarity. When businesses hold off on making new investments, it's bad for the overall economy. Jason Smith, the chairman of the House Ways and Means Committee, has been outspoken against the global minimum tax and first floated the idea of a revenge tax like this in a May 2023 bill. Republicans in Congress who are worried about the cost of Trump's big beautiful bill have been searching for revenue to keep its overall costs down. And according to the Joint Committee on Taxation, Section 899 would raise $116 billion over the next decade. Without it, the big beautiful bill would add even more than the projected $2.4 trillion to the US debt over the same period. The Wall Street Journal has argued that Section 899 is just a negotiating tool and that US lawmakers don't actually want to collect any revenue from it, suggesting that it'll never go into force. If this was true, lawmakers would not be relying on the $116 billion that the provision raises over the next decade to hit a specific budget target. According to the Joint Committee on Taxation, Section 899 is a rare tax hike on the wrong side of the Laffer curve, meaning that it's a tax hike that would likely reduce rather than raise revenues. The Laffer curve explains that very high tax rates can actually reduce collected revenue because they disincentivize work and investment, leading to slower economic growth and a smaller tax base. The Joint Committee on Taxation forecasts that the provision would start to lose the government money by scaring off foreign investors and therefore lowering American asset prices. Foreign investors who are subject to the US withholding tax make up a high percentage of taxable investors in US markets, as a lot of domestic investors are tax-free investors like foundations, university endowments, pension funds, and so on. If Section 899 was enacted, US companies could decide to reduce or eliminate dividends and switch to stock buybacks instead in order to avoid losing their foreign investors. There is a long history of companies adjusting their dividend policies when tax rules change, as a company becomes a better investment if it can return capital to its investors in the most tax-efficient manner. Other things that could happen is that companies located in countries targeted by Section 899 could choose to re-domicile in a different country to avoid being taxed. For example, a French business with a subsidiary in the United States who's struck by this tax could switch its headquarters to Dubai, for example, to get around being taxed by the US government. There is still a long way to go before Section 899 becomes law, and the Senate could throw it out entirely. The law, if enacted, would be bad for international investors who put money in the United States. And if Section 899 becomes law, they might want to reduce their exposure to US assets before the tax is actually implemented. It's not good for US investors either, as they might see the value of their investments fall as foreign investors sell, or see the interest rates in the businesses they invest in rise as they're forced to gross up foreign lenders. The rule would not be good for US businesses looking to raise capital either, as the pool of available capital would dry up. Section 899 wouldn't solve the problem that it's theoretically aimed at either, where American manufacturing jobs have moved abroad to low-wage countries in Asia. The harm that this tax could do to American businesses has, of course, not gone unnoticed by CEOs either. The FT reports that dozens of executives from some of the world's biggest companies have been traveling to Washington, D.C., booking meetings with lawmakers to push back against Section 899, warning that it could hit millions of American jobs. According to the Global Business Alliance, foreign-owned firms like Shell, Toyota, SAP, and LVMH employ 8.4 million workers in the United States. Those jobs could be eradicated if punitive taxes were thrown at these businesses in order to reduce the taxes paid by social media companies who employ a fraction of that number of workers and who don't appear to be struggling in the current economy. Gillian Tett writes in the FT that Trump's advisors are split on whether Section 899 is a good idea or not. She says that some, like J.D. Vance, love the idea of imposing revenge taxes on foreigners, as it'll play well with the MAGA base, and he believes that it could raise trillions of dollars in revenues. He's also backed by some of the biggest names in tech. Apparently, Howard Lutnick likes this legislation too, as he's keen to find new weapons to wield in his trade negotiations with the EU and Canada, especially now that a US federal court struck down Trump's reciprocal tariffs. Scott Bessent, on the other hand, is considerably less excited about invoking Section 899, as he doesn't want to scare global investors away from buying treasuries. One way or another, investors should probably worry that the US government would even consider passing a law like this, as no matter what happens, this is another action that's likely to undermine global trust in the United States, as it shows that the current administration is now considering the idea of moving from trade wars to capital wars, in pursuit of a goal that's quite hard to understand. Already this year, US stocks have been lagging the rest of the world after a long period of leadership, which became known as the American exceptionalism trade. Foreign demand for US assets reduces American bond yields, making it cheaper for the US government to finance its deficit. It also reduces the cost of capital for American businesses, making them more competitive than international firms. The immediate effect of these taxes would be to raise the cost of investment in the United States for foreign resident individuals or corporations. A higher cost of capital would reduce inbound investment, shrink the US capital stock, reduce labor productivity, and reduce wages. It is possible that foreign countries react to the threat of these taxes by repealing their taxes, as the Wall Street Journal suggests. But it's also possible that foreign countries retaliate with additional taxes on inbound investment. We already saw that happen with the tariffs. This sort of tit-for-tat economic warfare occurred during the Great Depression, making a bad situation worse. If the law did pass, it would be implemented on January 1st next year. If you found this video interesting, you should watch my video on whether China is dumping the dollar or not next. Don't forget to check out our sponsor Novium using the link in the description below or this QR code. Have a great day and talk to you again soon. Bye.